Welcome to Beyond the Benchmark, MarketMinds. I'm Brad Kasper with LSA Portfolio Analytics. Today, I want to discuss what may be one of the biggest structural shifts happening underneath financial markets right now, something we're calling the new capital cycle. Because for most investors, the world we operated in from 2009 through roughly 2021 became the only environment many had ever known. Low inflation, near zero interest rates, massive central bank liquidity, cheap and abundant capital. That environment rewarded long-duration growth assets, passive beta exposure, and traditional stock-bond diversification. In many ways, the entire investment framework of the post-financial crisis era was built around one central assumption: capital would remain inexpensive and widely available indefinitely. But that assumption may now be changing. Today, markets are confronting a very different backdrop. We have structurally larger fiscal deficits, higher inflation, volatility, geopolitical fragmentation, energy insecurity, supply chain rebuilding, and now one of the largest infrastructure investment races in generations centered around artificial intelligence. What's important here is that AI is not simply a software story. It's an infrastructure story. To build the AI economy, the world needs enormous investment into semiconductors, hyperscale data centers, electrical grids, cooling systems, cybersecurity, fiber networks, and power generation. At the same time, governments themselves continue issuing historically large amounts of debt to finance infrastructure, defense spending, entitlement programs, and rising interest costs. That means both the public and private sectors are competing for capital simultaneously. And when demand for capital rises faster than supply, the cost of capital typically rises as well. That may help explain why long-term treasury yields have remained elevated despite slowing economic growth in certain areas. The bond market increasingly appears to recognize that deficits are no longer temporary, more cyclical. They are becoming structural, and that has major implications for portfolio construction going forward. For decades, investors benefited from falling inflation and declining interest rates. Bonds often rallied during periods of equity stress, helping stabilize diversified portfolios. But in a world of structurally higher inflation volatility, that relationship can become less reliable. Inflation shocks can pressure both stocks and bonds at the same time. That doesn't mean diversification is dead. It means diversification may need to evolve. We believe this environment increasingly favors flexibility, active management, and a greater focus on balance sheet strength, pricing power, cash flow durability, and real asset exposure. Within equities, areas tied to infrastructure, industrial modernization, energy systems, and selective AI beneficiaries may continue to see long-term tailwinds. Within fixed income, we believe active duration management, income generation, credit quality, and flexible bond strategies become increasingly important. The biggest takeaway is this: the investment world built after 2008 may not be the investment world that defines the next decade. The next cycle may be defined less by excess liquidity and more by competition for capital. And while transitions like this can create more volatility and uncertainty, they also create opportunity for disciplined investors willing to adapt. Thanks for joining us on Beyond the Benchmark, Market Minds. I'm Brad Kasper with LSA Portfolio Analytics, and we'll see you next time.